Every dollar in your wallet was created as debt, not printed by a government, not backed by gold, created from nothing the moment a bank issued a loan to someone who needed it. And that loan, and every loan like it, is the reason the modern economy exists at all. This is not a conspiracy theory. It is how money works, and once you understand it, you will never look at a bank, a mortgage, or a financial crisis the same way again. Most people carry a mental image of how banking works. You deposit money, the bank keeps it safe. When someone needs a loan, the bank lends out the deposits it has collected. Simple, logical, almost completely wrong. The system that actually exists is called fractional reserve banking, and it works like this. When you deposit $100 in a bank, the bank is required to keep a fraction of that, say 10%, in reserve. The rest it can lend out, so it lends $90 to someone else. That person spends the $90. It gets deposited in another bank. That bank keeps $9 in reserve and lends out $81, which gets deposited again and lent out again. $100 of original deposit becomes, through this chain, roughly $1,000 of money circulating in the economy. The bank did not find that extra $900 somewhere. It created it by lending. This is called the money multiplier, and it means that every time a bank issues a loan, new money comes into existence. Not transferred, created. But this is only half the picture, because in the modern economy, the money multiplier model itself is incomplete. In 2014, the Bank of England published a paper that made an admission most economics textbooks still have not caught up with. The paper stated plainly that banks do not lend out deposits. When a bank makes a loan, it simply credits the borrower's account with a new number. That number did not exist before the loan was made. The bank did not need deposits to create it. It created the money first, and the deposit, the liability on the bank's balance sheet, came into existence at the same moment. This is called endogenous money creation. And what it means is that money in the modern economy is not a thing that exists and gets moved around. It is a record of a promise. A loan is made, a number appears. That number circulates as money. If the loan is repaid, the number disappears. The money is destroyed. Across the entire economy, the money supply is not controlled by the government printing cash. It is controlled by the collective lending decisions of thousands of commercial banks responding to demand. Money is debt. All of it. Right now, every pound, dollar, and euro in circulation exists because somewhere in the system, someone owes it back. So what happens when the lending stops? In 2008, the answer to that question became the most expensive lesson in economic history. The crisis began in the United States housing market. Banks had spent years issuing mortgages to borrowers who could not reliably repay them. Those mortgages were bundled together into financial products called mortgage-backed securities and sold to investors around the world as safe assets. When housing prices fell and borrowers began defaulting, the value of those securities collapsed. Banks that held them suddenly found that their assets were worth far less than their liabilities. They stopped lending. When banks stop lending, new money stops being created. The money supply contracts. Businesses cannot borrow to make payroll. Consumers cannot borrow to spend. The economy begins to shrink. Between 2007 and 2009, the United States lost approximately $8 trillion in household wealth, not because the physical buildings and machines and human skills had disappeared, because the promises underneath the money had broken. The economy did not lose real things, it lost confidence in the numbers. Economist Hyman Minsky spent his career warning that this was inevitable. His theory, now called the Minsky moment, argued that financial stability is inherently self-destabilizing. When the economy is growing and loans are being repaid, banks become more willing to lend, standards loosen, borrowers take on more risk, asset prices rise, optimism compounds, until the system is so leveraged, so stretched, so dependent on continued growth that any disruption, a default, a rate rise, a rumour, triggers a cascade of deleveraging that can collapse the entire structure. Stability breeds instability. The longer the boom, the worse the bust. Minsky made this argument for decades. Almost no mainstream economist listened. Then 2008 happened, and suddenly everyone was talking about the Minsky moment. Here is the thing that should stay with you. The system is not broken. It is working exactly as designed. Debt-based money creation has produced the longest and broadest expansion of human prosperity in history. The credit system funds hospitals, schools, clean energy, and scientific research. It allows billions of people to own homes, start businesses, and build things that would otherwise take lifetimes to save for. But it is a system built on trust, on the collective belief that the promises underneath the numbers will be kept. And when that belief fractures, not just in one bank or one country, but across a connected global system simultaneously, the consequences are not just financial. They are human. Jobs lost, homes repossessed, decades of savings erased in months. Every dollar in your wallet is a promise someone made. The entire economy is a network of those promises, stacked on top of each other, stretching back decades. It works remarkably well, most of the time, until it does not.